Question 9. What are the key risks associated with the DIV ETF's investment strategy? The DIV ETF, or Global X SuperDividend U.S. ETF, prioritizes high current income through dividends from U.S. companies. While it offers potential benefits, there are also key risks associated with its investment strategy. Focus on high dividend yields. Lower growth potential. Companies that prioritize high dividends often reinvest less of their profits back into the business for growth. This can limit the long-term capital appreciation potential of the ETF's holdings compared to growth-oriented stocks. Vulnerability to interest rates. When interest rates rise, dividend-paying stocks can become less attractive compared to bonds or other fixed-income investments that offer higher yields with less risk. This could lead to a decline in the ETF's share price. Exposure to value traps. In their pursuit of high yields, the ETF might invest in companies with seemingly attractive dividend yields but facing underlying issues. These value traps could experience declining stock prices, negating the benefit of the dividend. Underlying index tracking. Limited flexibility. The ETF's holdings are primarily driven by the composition of the X SuperDividend U.S. Low Volatility Index. The ETF manager has limited flexibility in selecting additional securities outside the index. Index concentration risk. The ETF's performance is heavily tied to the performance of the underlying index. If the index experiences significant losses, the ETF will likely follow suit. Other potential risks. Market volatility. Even though the ETF focuses on lower volatility stocks, its share price can still fluctuate with the overall market. This can lead to capital losses for investors. Sector concentration. The ETF might have a higher allocation to certain sectors known for high dividends, such as financials and utilities. If these sectors underperform, the ETF's returns could suffer. Question 10. Does DIV ETF contribute to portfolio diversification? The DIV ETF, or Global X SuperDividend U.S. ETF, can contribute to portfolio diversification, but it depends on your existing portfolio holdings and your overall diversification strategy. Here's a breakdown of the pros and cons. Potential diversification benefits. Different asset class. If your portfolio primarily consists of stocks that don't prioritize dividends, adding DIV ETF introduces exposure to a different asset class within equities, high dividend stocks. This can help spread your risk across different investment styles. Lower volatility. The ETF focuses on lower volatility high dividend stocks. While not immune to market fluctuations, these holdings might offer some stability compared to the broader market, potentially reducing the overall volatility of your portfolio. Income stream. The regular dividend payouts from the ETF can provide a steady stream of income, which can be a valuable component of a diversified portfolio, especially for income-seeking investors. Limitations to diversification. Equity concentration. Even though it focuses on a specific dividend strategy, DIV ETF remains an equity investment. If your portfolio is already heavily weighted towards stocks, adding DIV ETF might not significantly enhance diversification across asset classes, e.g., bonds, commodities. Sector concentration. The ETF might have a higher allocation to certain sectors known for high dividends, such as financials and utilities. If these sectors are already well represented in your portfolio, adding DIV ETF might not provide significant diversification across sectors. Maximizing diversification with DIV ETF. Existing portfolio composition. Consider your current asset allocation and sector weightings. If your portfolio lacks exposure to high dividend stocks or specific sectors the ETF focuses on, then DIV ETF can enhance diversification. Combine with other strategies. Pair DIV ETF with other asset classes like bonds or commodities to achieve a more well-rounded diversification across asset classes. Limited allocation. Don't rely solely on DIV ETF for diversification. Consider it as a part of your overall portfolio strategy, potentially alongside other ETFs or individual stocks with different risk-return profiles. Overall, the effectiveness of DIV ETF for portfolio diversification depends on your existing asset allocation and investment goals. Question 11. Are there other ETFs with similar objectives of DIV ETF but lower expense ratios? Yes, there are several ETFs with similar objectives to the DIV ETF, Global X SuperDividend U.S. ETF, but potentially lower expense ratios. Here's a breakdown to help you compare DIV ETF and similar options. Objective: all these ETFs target high-dividend-paying U.S. companies, aiming to generate income for investors. Underlying index: while the DIV ETF tracks the X SuperDividend U.S. Low Volatility Index, other ETFs might use different indexes with similar goals of selecting high dividend payers. Potential lower expense ratio options. Here are some examples of ETFs that focus on high-dividend U.S. stocks and may have lower expense ratios compared to the DIV ETF. Expense ratio around 0, 56%. SPDR SP Dividend ETF, SDY, tracks the SP High Yield Dividend Aristocrats Index, focusing on companies with a history of increasing dividends. Expense ratio around 0, 7%. Vanguard High Dividend Yield ETF, VYM, tracks the FTSE High Dividend Yield Index, offering broad exposure to high dividend-paying U.S. companies. Expense ratio around 0, 6%. iShares Select Dividend ETF, DVY, tracks the Dow Jones U.S. Select Dividend Index, aiming for high dividends with a quality bias. Expense ratio around 0, 35%. Important considerations when comparing. Expense ratio. While a lower expense ratio is generally preferable, it's not the only factor. Analyze the specific holdings and index methodologies of each ETF to understand potential differences in risk profile, sector concentration, and dividend yield. Underlying index. The index selection process can influence the characteristics of the ETF. Some indexes might prioritize high current yields, while others might focus on companies with a history of increasing dividends, dividend aristocrats. Investment objective. Consider if you prioritize high current yield or a combination of current yield and potential for future dividend growth. Question 12. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, you could potentially achieve a similar outcome to the DIV ETF, Global X SuperDividend U.S. ETF, with a combination of individual stocks or other ETFs, potentially offering lower costs or greater control. Here's a breakdown of the pros and cons. Potential benefits of individual stocks or ETFs. Lower costs. By selecting individual stocks or other ETFs, you can avoid the expense ratio associated with the DIV ETF. You might find individual stocks with lower commission fees or ETFs with even lower expense ratios. Greater control. You have complete control over which companies you invest in, allowing you to tailor your portfolio to your specific risk tolerance and dividend yield preferences. Tax efficiency. If you choose individual stocks that qualify for preferential tax treatment on dividends, assuming you are a U.S. taxpayer, you might benefit from lower taxes compared to the potentially less tax-efficient dividends from the ETF. Challenges and considerations. Research and analysis. Selecting individual stocks requires significant research and analysis to assess their financial health, dividend history, and future growth prospects. This can be time-consuming and requires a certain level of investment knowledge. Diversification. Building a diversified portfolio with individual stocks can be challenging. You would need to invest in a variety of companies across different sectors and industries to manage risk. Trading costs. Frequent buying and selling of individual stocks can incur commission fees, potentially eroding your returns. Consider using a commission-free brokerage platform if you choose this route. Monitoring and rebalancing. You'll need to monitor your individual stock holdings and potentially rebalance your portfolio periodically to maintain your desired asset allocation and risk profile. Alternative ETFs for similar outcome. Several ETFs offer exposure to high-dividend-paying U.S. companies with potentially lower expense ratios compared to the DIV ETF. You could explore these options as a way to achieve a similar income-focused outcome with potentially lower costs. Question 13. What are the pros and cons of this DIV ETF compared to similar options? Here's a breakdown of the pros and cons of the DIV ETF, Global X SuperDividend U.S. ETF, compared to similar options. DIV ETF pros. Focus on lower volatility. Unlike some high-dividend ETFs, DIV focuses on companies with lower volatility compared to the S&P 500. This might offer some stability during market downturns. Income generation. The ETF prioritizes high-dividend-paying U.S. companies, aiming to provide a steady stream of income for investors seeking this specific outcome. Convenience and diversification. The ETF offers instant exposure to a basket of high-dividend stocks, eliminating the need for individual stock selection and providing built-in diversification within the U.S. market. Transparency. The ETF tracks a well-defined index, X SuperDividend U.S. Low Volatility Index, and its methodology is publicly available. DIV ETF cons. Higher expense ratio. Compared to some similar high-dividend ETFs, DIV has a higher expense ratio, around 0.56%, which can eat into your returns over time. Limited control. Investors have no control over the specific companies held within the ETF. The holdings are dictated by the underlying index. Potential for lower growth. Companies that prioritize high dividends often reinvest less of their profits back into the business for growth. This could limit the long-term capital appreciation potential of the ETF's holdings compared to growth-oriented stocks. Concentration risk. The ETF might have a higher allocation to certain sectors known for high dividends, such as financials and utilities. If these sectors underperform, the ETF's returns could suffer. Similar options pros. Lower expense ratio. Several ETFs achieve similar high dividend objectives with lower expense ratios, potentially boosting your returns. E.g., VYM, DVY. Potential for broader exposure. Some similar ETFs track broader indexes encompassing a wider range of high dividend-paying U.S. companies, offering potentially more diversification across sectors. Similar options cons. Potentially higher volatility. Some similar ETFs might not have the same focus on lower volatility as the DIV ETF, potentially leading to higher price fluctuations. Less transparency. The specific selection criteria for some similar ETFs might be less transparent compared to the DIV ETF's index-based approach. Question 14. What are the potential benefits and drawbacks of investing in DIV ETF compared to individual stocks within the same sector? Here's a breakdown of the potential benefits and drawbacks of investing in the DIV ETF, Global X SuperDividend U.S. ETF, compared to individual stocks within the same sector focused on high dividends. Benefits of DIV ETF. Diversification. The ETF offers instant exposure to a basket of high dividend-paying U.S. companies within a specific sector, reducing your concentration risk compared to holding just a few individual stocks. Convenience and lower management time. You don't need to research and analyze individual companies. The ETF takes care of the selection and weighting based on the underlying index. This saves time and effort. Lower transaction costs. Purchasing a single ETF share might be more cost-effective than buying shares of multiple individual stocks, especially if you're using a commission-free brokerage platform. Transparency. The ETF tracks a well-defined index, and its holdings and methodology are publicly available. Drawbacks of DIV ETF. Higher expense ratio. The DIV ETF has an expense ratio, around 0.56%, that eats into your returns. With individual stocks, you would only pay commission fees for buying and selling. Limited control. You have no control over the specific companies held within the ETF. The holdings are dictated by the underlying index. You might miss out on potentially higher growth companies within the sector that the index doesn't include. Potentially lower returns. The index selection process might exclude some high-growth, high-dividend companies that individual investors could identify through research. Benefits of individual stocks. Potential for higher returns. By carefully selecting high-dividend stocks with strong growth potential within the sector, you might achieve higher overall returns compared to the ETF's average performance. Greater control. You can choose individual companies based on your research and investment thesis, potentially allowing you to outperform the ETF's holdings. Tax efficiency. If you choose individual stocks that qualify for preferential tax treatment on dividends, assuming you are a U.S. taxpayer, you might benefit from lower taxes compared to the potentially less tax-efficient dividends from the ETF. Drawbacks of individual stocks. Higher risk. Investing in a single company carries more risk compared to a diversified ETF. A company's performance can significantly impact your portfolio. Research and analysis. Selecting individual stocks requires significant research and analysis to assess their financial health, dividend history, and future growth prospects. This can be time-consuming and requires a certain level of investment knowledge. Trading costs. Frequent buying and selling of individual stocks can incur commission fees, potentially eroding your returns. Consider using a commission-free brokerage platform if you choose this route. Monitoring and rebalancing. You'll need to monitor your individual stock holdings and potentially rebalance your portfolio periodically to maintain your desired sector allocation and risk profile. Alright everyone, there you have it. We've explored the ins and outs of the DIV ETF. Remember, the DIV ETF offers a convenient way to access a specific combination of high dividend yields and lower volatility within the U.S. market. For those who prioritize income and a hands-off approach, the DIV ETF could be a great option. But if you're a seasoned investor seeking maximum control or tax efficiency, individual stock selection or alternative ETFs might be worth exploring. Don't forget to like this video and subscribe to Chat ETF for more in-depth discussions on all things ETFs. In the comments below, let us know your thoughts on the DIV ETF. Would you consider adding it to your portfolio?